You know, my very most important day that I'm working on all of this stuff is Fridays, because that's the time when I really have no interruptions and I can just focus on what's going on. And I always listen to Bloomberg because I like the way they give me the stories over here and the stories over there. And I kind of listen with half the ear while I'm doing all of my research. And every once in a while I hear something, I go, And that's what happened on Friday. And what I discovered when I dug into what I heard, just a little fleeting comment, right, was that there is a banking crisis that is unfolding as we speak, but it's hidden from you. I don't know when it's going to become apparent. It could happen very, very soon, but you need to know about this because you need to get into proper position. It's happening. This is not something I'm waiting for. Let me show you what I'm talking about. Because legally, you are the beneficial owner. So it makes it look like you own something, but you really don't. Any of these intangible instruments, assets, stocks, bonds, ETFs, mutual funds, annuities, all that stuff, you are just the beneficial owner, not the legal registered owner. So what you're looking at here is a Yale Law School study on custodial ownership. Who really owns all of these intangible assets? And you can see that it's pretty complicated in here. But this is also the reason why nobody went to jail for creating the crisis in 2007, 2008, because there's hypothecation and there's rehypothecation. And I'm going to explain that in just one little second. But what this flow chart shows you is that the big banks here are the legal registered owner of all of those intangible assets. So in court, this is exactly why no one went to jail, because they're the ones that write the contracts. They're written for their benefit, not yours. And one of the things that they can legally do is use your equity for their benefits. So between the big banks over here and all of these banks and brokerages in between, and this can be very, very long string of ownership, every single one of them gets to use your equity for their benefit and use it as collateral to borrow and then go out and take all sorts of risks and trade and do whatever they want. Here you are way down on the bottom. So if you go to court, guess what? Legally, too bad, so sad. It enables everything that I'm about to show you in the banking crisis that is unfolding right this second. Hypothecation is that legal right of the banks and the brokerages to use your equity for their benefit. Rehypothecation is, if this is done through the City of London, which most of these contracts are written in, there are no limitations to how many entities can use that same collateral and go out and gamble with your equity. And you never see it until you see it. But banks make most of their money through trading, and they do that by using your equity to borrow and trade. Now, the reality is that gold is the only financial asset that you cannot do this with physical gold in your possession. They can do it all they want with digital gold and create a whole bunch of gold that does not nor ever will exist. But let me show you what's happening right now, because I started by telling you fintech fight leads to hundreds of thousands of frozen accounts. So this is now coming to light, though, as you'll see, they've known about it for a couple of years. But is this the banking crisis that's going to topple over the global financial structure? Because what they want is to think that it's just in this little area. But what we know and what they've shown us time and time again is that all of the global banks are incestuously intertwined. And they may say to you, oh, that's just in the regional banks, or oh, that's just in the smaller banks, or oh. But the reality is that those big commercial banks, the SIFIs, systemically important financial institutions like Chase and Bank of America and Wells Fargo and Citi and all those guys, those big commercial banks are how smaller banks get funded. And this is an extraordinarily fragile financial system. We're already watching more and more banks fail. That started last year, right about this time, a little bit earlier than this. And it's not over yet. It's not over yet. So you want to make sure that you watch the video that I did last week on the FDIC's quarterly report and how vulnerable these banks are and the fact that they know there's going to be a bail-in. But hey, sophisticated people will be able to understand what's going on. Let me show you the scope of this problem. Synapse is one of the largest players in the banking as a service space, which allows fintech startups to offer banking services by partnering with FDIC insured banks. So when you look on all their literature, it looks like everything is FDIC insured banks. And as long as that money happens to be in the FDIC insured bank when it collapses, well, it is. But unfortunately, the documents that you signed and agreed to open up a new account give them rights in that structural ownership chart that I just showed you to do other funny things, which I'm going to show you. Okay, the company had contracts with 20 banks and 100 fintech firms serving 10 million users. That means 10 million people like you and me that could potentially be impacted by that. So let me repeat, because this is so important. 20 banks, 100 fintech firms, and 10 million end users. It is so convenient to hold everything on your phone. But when it goes bad because, hey, if you don't hold it, you don't own it. Okie dokie. These partnerships allowed companies and what they call neobanks, right, to gather deposits and advertise themselves as FDIC insured. And that gives customers a false sense of security. And I got to say this, FDIC insurance itself gives people a false sense of security. It was created back in, what year was that? 1933, during that banking crisis there where the public lost all confidence and faith in the system. So it was put in place and, hey, what do I worry about? I'm insured. Well, you are as long as they have the money. And of course, they can print as much as they want. And we've certainly seen in this past year-ish or so how they can bail out those that are chosen because they don't want you to understand that you can be bailed in. And you're saying, well, this is just the fintechs. 20 banks. 20 banks. The effect of that large-scale withdrawal is unknown. What are they talking about here? Right now, all of those funds are, boom, locked. You can't get your money back. What happens when those funds are unlocked? Will there be a run on the fintech companies and how they're integrated into the banks? Because the problem is that there's a lot of money that's missing and they have no idea where it is. We'll talk about that in a second. But how do you think 20 banks, a run at 20 banks would have an impact on your bank? Because it's going to impact the global banks. I don't know if they can keep this one covered up or hidden. But this is legal. That transfer without notice, that first graph, that's why I had to stop it, because until you understand that you really don't own anything, you can remain vulnerable. So in those contracts that you signed with the fintech company, you agreed that they could transfer this stuff without notice. And they don't have to tell you anything else because you already agreed on it. The fintech business model of relying on unregulated middlemen like Synapse, they're unregulated. And not that the banks are much better being regulated. However, The middleman, like Synapse, has led to this crisis where customers are unable to access their funds due to disputes between the various companies involved. And there's 85 million so far. There may turn out to be more in unaccounted for losses. That money is just gone and they don't know where it is. This is part of the costs. They're hidden costs in those conveniences. And think about it. That's how they always sell all of these innovations, is how convenient. Oh yeah, who wants to go in and work with dirty cash or heavy gold? Just put it in the cloud and there you go. You got nothing to worry about until you do. These are hidden costs that you're not aware of, but you need to be aware of. Because when you make that deposit, I don't care who it's to, you have actually loaned that entity your wealth. It's not yours anymore. You become a creditor. That's what that flow chart shows you. The bankruptcy trustee says that 85 million of customer savings is missing in this fintech meltdown. And this is not over yet. This is unfolding. The reason why you can't see it is because all those funds, the access to them is locked up. The scary part comes when they open up and they allow people to withdraw money. I don't know how long that's going to take, but I'm definitely watching it. Hypothecation and rehypothecation, which is using your equity as loan collateral. No one knows who owns or holds what because they've got 20 banks that they're working with, 100 fintech companies. This money goes here and then it goes there and it goes here and it goes there and this is used here and it's used. Can you get the picture? It is so convoluted that they can't keep track of it. Where is all of that money? Where did it go? Are they going to be able to figure this out? And how long is that going to take? Because I'm going to tell you right now, nobody's likely getting anything until they figure that out. Is that going to take a week? Is it going to take a month? Is it going to take years? I don't know. But when that happens, if people have access, would you continue to keep your money in some place that locked you out so easily? And by the way, I want you to think about this. What 10 million customers? I don't know who's lost access, but if that's where they were putting their money to pay their bills, how do you think that's going to impact not just them, but whoever they owed their money to? Can you see this snowballs? It's huge and it's scary. Shortfalls that may have existed at each partner bank and at an earlier time is not known at this time. But hey, they make an awful lot of money through that hypothecation and rehypothecation and using your equity, and you have no clue. And it's not the fintech companies that I'm talking about for the hypothecation and rehypothecation. It's your banks that I'm talking about. So this is an early warning, but I'm telling you, this banking crisis could topple the entire system. Users whose funds were pooled in a communal way known as, and I want you to write this one down, for benefit of, or FBO accounts, will have a harder time getting their money legally. So you go into a brokerage. Now look, I started in the 80s at Shearson. And at that time, it was all about pushing people to hold funds in-house. Prior to 71, most people held their stock certificates. Most people held their bond certificates. In that case, if you're holding these certificates, the banks and the brokerage houses cannot use your equity for collateral. So they needed all of that gathered in-house. That's what they're talking of. That's what they're talking about. So if you have a brokerage account, if you have a 401k, if you're in these mutual funds, I'm telling you, you've got to read those. You've got to read those prospectuses. An easy way to do that and to check and see if you're vulnerable is go ahead and your administrator would have all of the prospectuses online. You can pull that prospectus up, do a Control F at the same time. That is a search key, a find key, and put for benefit of in there, and see how many times that comes up, and then you're going to know. But I'm going to tell you, if you don't hold it, you don't own it. So if you don't want to do that search, if you're holding it in a brokerage account, a 401k, an IRA, a 403b, and a variable annuity, any of those things, you have a for the benefit of account. And it's for your benefit, but you're the one that pays the price, takes all the risk. They're the ones that make all the money. Fintech crisis leaves millions of Americans unable to access their money and pay their bills. I'm reminding you, 36 fintech companies are impacted. These are the ones. You can see that they're small, but follow those links and see if you're doing anything with fintech companies. Is yours involved in this? And I don't know that this is a complete list that are part of this issue at this point. So it might be something that you want to dig much deeper into, but everybody is impacted, even if you don't have a fintech account. I don't have a fintech account, but I do have a bank account, right? I'm going to be impacted by this. I just don't know when. That's the point of being prepared. Over 1 million Americans may be affected and unable to access their money, except that there are 10 million end users. So are they trying to make this look like, no big deal, it's 1 million people? If you're one impacted, you're going to think it's a big deal. But we have not heard the last of this yet. It's still really, really quiet. Have you heard many people talking about this? Because the bottom line is, and this is why I got to hammer home to you, gold is the only financial asset that runs no counterparty risk. All this other stuff, they're all contracts. And they're all, and so you are a counterparty to these contracts, and they're doing stuff on your behalf. And you want to think that they're supposed to take your best interest into account, but they don't have to take your best interest to account. They're taking their best interest to account. I want you to take yours. I want you to put your goals first. And what does the FDIC have to say about all of this? Because, of course, now these funds are frozen. The fintech companies are failing. Maybe some banks are failing from this. And the FDIC, Consumer News, comes out and say banking with third-party apps, not our problem. FDIC deposit insurance does not protect against the insolvency or bankruptcy of a non-bank company. Fintechs are non-bank companies. They partner with banks to make them look like a bank and deceive you, but they are not banks. They do not have, and I say this tongue-in-cheek, any FDIC protection, but goodness gracious, by their own admittance, they've got a teeny bit more than a penny to support every single insured deposit, forget uninsured deposits. And so what happens if there's a bank run at 20 banks? It'll become very clear very quickly that there is a much bigger problem than you see. And if enough risk has been transferred, guess what? Like in 29, like in 1970, again in 2008, these markets will just become too expensive to support. Not for you. You are a systemically important financial individual for your family, but not for the world. The banks are for the world. That's who they're protecting. Because what about the contagion from those 20 banks, 36 fintechs, and 10 million customers? Everybody's going to be impacted by this. Are you ready? But I love this because, I don't know, I'm thinking perhaps the owner, the guy that created the CEO of Synapse, knew something was brewing. Yeah, they knew about it because there he is raising new funds for a new robotics startup. Problems at Synapse were known for at least 2 years, but this is the first we're hearing about it. What do you think about that? And by the way, funded by private equity, I got to tell you. Foundation was started in April. Let's see, what month is this? Oh, June! So what is he doing? Getting out while the getting is good? Do you think he might have known that there were problems here? That the end users didn't? That they were not advertising? So people are lulled into this false sense of security. Everything is fine and hunky-dory when it is not. When they have risked their principal for convenience or a little pickup in interest. This is not the time to be taking any risk. And I think central bankers have shown us, this is a risk-off asset. Gold is, physical gold in your possession. I don't know. I saw this with WeWork and Andy, whatever his name is, walking away smelling like a rose when everybody else that invested in WeWork ate it in the shorts. I don't know. Is he trying to walk away from this banking crisis? Can he legally walk away from it? These are things that have yet to be divulged, but I'm going to tell you. I know I goofed this up, but this is such an extremely important video. You need to share it, because this is a banking crisis that is in place right now. It's just being hidden because the funds are locked up. I can't tell you when they're going to unlock the funds. I can't tell you what's going to happen when they unlock the funds. I think that we're going to have a complete meltdown. We could easily be that close. Can they bail out 20 banks? Can they bail out? I don't know. Where's that 85 million? I don't know. Let's hope you're not involved in this, but let's make sure that you're not involved in this, that you are protected. There is that QR code that's coming up on the screen. You can click on that and make a direct link to set up an appointment with one of our strategy specialists. You can click the link below and make that appointment. I'm telling you, get it done. We are all here to be of service. We are paying attention to what's going on, and we want to be a solution for you. We want to help protect you from what is already unfolding. And how much more money do they have to print to make this hide what's happening? Can they print enough money for that? I don't think they can print enough money for that. We'll find out. And I don't know if they can come up with, some other trick to postpone this a little longer, or if they feel like enough risk has been transferred. And then, I'm telling you, they do it every single time. And even though I can't guarantee what's going to happen tomorrow, if something happens the same way every single time and they're doing the same thing, what do you think the end result is? They want you to believe that this time is different, but it's never different, and it's not this time. And you need to know that banking crisis, the next one that is likely to rear its head, it's already rearing its head.